Well, good morning, everyone. Thomas Montgomery. It's great to be with you this Monday morning. Today is August 4th, 2025. We get together most weekday mornings at this time, 8 o'clock Central, talk about strategies, tips, techniques, share success stories, and support each of you. Last week we had actually parts one and two announcing and explaining the ABL, the asset based lending program, and it's incredible. And I think it deserves a follow-up discussion today. We're going to approach it so even if you didn't attend the trainings last week, I think we'll go basic enough that this will make sense. But then we're going to add some additional content. So if you were on last week's or viewed last week's, it'll still be worth your time. So with the shared screen here, asset-based lending, the best kept secret in business funding. A lot of the strategies that we use are based around what larger businesses have done. And ABL, which we'll go through what it means and how it works in a moment, is not something that's new in the lending world, but it's typically not been available to early stage businesses. And so we've been able to find a legal, ethical, innovative way to take ABL as well as some of our other protocols and make it available for early stage businesses. All right, so with that, a website 509 Pacific. If you need help, text 903-347-8042. All right, introduction on ABL. So, asset based lending is a type of financing that allows businesses to borrow money based upon the value of their assets. So, what do you and I know? If a business owner wants to borrow money, they want funding, they need to qualify for whatever type of funding that they're applying for. Kind of makes sense, but that's typically where the problem arises. A lot of people want money, a lot of people need money, but they're usually not qualified. Well, what qualified means depends upon what type of funding we're going after. ABL is an outlier. It is a faster, easier way to get funding, but also requires less documentation. Now, so what we've covered here is we're trying to get funding, and we're getting funding based upon the value of their assets, which kind of makes sense because asset is the first word of asset-based lending. So the first thing we need to understand is, well, what type of assets could we use to get funding for ABL? In some cases, existing inventory can work. What we're going to focus on in our model, and you and I working together, is AR, accounts receivables, but also some clients could have enough equipment or enough real estate to qualify. Now, if we're working with a group of clients that don't already have the assets, as we'll go through, you and I can provide them the assets so they can use ABL. But there's only one of these four categories of assets that will work. Because if we went out and bought, let's say we're working off of $1 million business loan. Well, to use inventory, we would need to go buy $1 million of inventory. Well, if we didn't have $1 million to start with, how would we go get $1 million of inventory? Same for equipment, same for real estate. Now, a lot of people have real estate, but they usually have a lien, a loan already against it. So then it wouldn't work for this purpose. So the outlier of these four are accounts receivables. We can get AR literally for a penny on the dollar, but use 100 cents on the dollar as collateral for ABL. ABL is different from traditional business lending, which normally relies more on creditworthiness and cash flow of the borrower. So, just as I mentioned, ABL is faster, easier, and also, in many cases, less expensive. ABL can provide more flexibility, liquidity, and security for businesses that need working capital, growth capital, or debt restructuring. I don't really want you to pay much attention to these descriptions because the beauty of ABL is it's unrestricted. It could be used for anything. It could be used to transfer to a second company to go buy a business or transfer to a second business to spend however it wants. So ABL, the beauty of it is when that money comes into the client's bank account, it's unrestricted. And that is a difference from a lot of traditional business loans and SBA loans where we have to tell the lender what the money is going to be used for. If you recall, we've had a number of trainings in the past about use of funds. Well, when it comes to ABL, we don't have to tell anyone what the use of funds are. Now, I know that commonly the barrier has been that most small businesses, they don't have enough assets, so the ABL is irrelevant. However, what we're able to do is literally transfer the assets legally and ethically to put on the participant's balance sheet. So, correct, asset-based lending requires assets. However, we can provide the assets, and the type of assets that we would provide would be specifically accounts receivables, which has several benefits that we'll talk about. So that's kind of the high level introduction. It's an alternative, or it could be a complement. It could be used in conjunction with an SBA loan or a line of credit or non SBA loan. But in many cases, I think you'll find many of your clients or prospective clients would really be interested in ABL if they were properly educated. So here we are educating you so you can take this message as you deem appropriate out to the community to help. All right, so let's dig a little bit deeper into the specifics. Kenny does have a question. Is there a cap? There is not a cap. And so we're going to talk about some examples, some success stories here in a minute. But you can look at companies like Tesla, companies like Walmart, big publicly traded companies that are highly regulated. So you know they're not going to do anything that's illegal or inappropriate. Walmart and Tesla are both great success stories of using ABL. So there is no max other than we need to have enough assets to pledge. And we can theoretically provide as much as needed. So thank you, Kenny, for that question. All right, so let's get into the benefits. Now, these benefits have a lot of overlap of what we covered last week, but we've refined them a little bit based upon the discussions we've had with many of you. So, what are the benefits of ABL? Well, increased accessibility would certainly be number one. It's easier to get. Well, why is it easier to get? Well, don't fall into a trap. So, we're never going to get funding that we don't qualify for. That's a dream, that's a hope, that's a prayer, maybe it's a scam, but we only get what we qualify for. And that's why you and I are doing so well in this business model is a lot of people don't qualify. So they're going to have to qualify, but it still is easier to qualify. Why? Because it's based upon the value of their assets versus a lot of other things that traditional loans normally are. So there's less underwriting involved. How does that sound? Well, because it's easier, it's also faster. Faster to get an approval and faster for funding because there's less underwriting to do. The approval process tends to be quicker because lenders prioritize the collateral value over other things, including other elements of the business and other elements of the business owner or owners. As I referenced earlier, it's great because it's unrestricted. There's greater flexibility in the use of funds. So let's say that we wanted, let's say, regardless if it's the total capital raise, let's say we need 100,000 to pay off some personal debts. Well, we can't go normally to the SBA or for a business loan and say, hey, bank, I have some personal debt I'd like to clear off and move it over to the business side. That's not a permissible use in most cases, but it certainly is with ABL because there are no restrictions. I see Kenny's asking, do we need a Dun and Bradstreet profile? No, no. So that's you're picking up on the theme here. There's much less variables. There's fewer variables. There's less underwriting for ABL. All right, next bullet, higher borrowing limits. And this gets to the point that was made earlier. There's really no cap. Now, we need at least 1 million to make it worthwhile. So we won't do any ABLs less than 1 million because that's where most of our ABL lenders start. However, with that being said, there's no cap. But regardless of big numbers, the point is you could take the same client and typically we would be able to get more in funding through ABL than we would be able to through a traditional loan, just because the way it's underwritten. Leverage is a proven model. So, as I mentioned, Tesla has used ABL for massive capital raises. Walmart, lots of large companies have. You and I, we're not unique in the sense that we know something other people don't. It's just you and I have access to an implementation model of ABL that can be used by earlier stage smaller businesses than is commonly available. And then the last bullet here is to the extent that you want to get paid to help people, it's incredible, right? So you can have a branch office in your community, a true physical brick and mortar office. We've had a number of trainings on that. You can see that on our website if you need 509 Pacific. And then you're essentially an extension of us and fulfilling the three mandates of the grant. And if you recall, the three things that we're mandated to do through the grant is number one, educate on financial literacy. Number two, give away free shelf corps. And then third, facilitate access to funding. So while it's great to help people, it's also a significant revenue stream for you if you want to own a branch office because you're making 5% in addition to some other incidental sources of funds or revenue streams. The biggest bulk comes from the client's capital raise, which is what you would want, what they want, right? We want to be paid off of delivering what we promised to do. And as a branch office, you're making 5%. Maybe that doesn't sound like much, but most of our clients now are pursuing larger capital raises, less of the little dinky small ones. And at $1 million, $5 million capital raise at 5%, you're at 50,000 a pop. Some of you are really getting into the groove of generating significant volume. If I can kind of toot Selena's horn for a moment, and she's on this morning, if I recall correctly, we've processed over 20, I think it's around 21 or 22 of Selena's clients since Friday. So some of you have really figured out how to educate properly, how to explain the shelf corp, and how to close deals. And Selena is an example, but there's a number of you, a great example. Good job, Selena. A number of you are doing 10, 20 or more per week. So you start taking, to just take Selena's past week, we'll round it off to 20. 20 times 50,000. I mean, she literally is on track to generate for her branch office, her distribution partnership, $1 million for the month of August. And I know to some of you, maybe that's not that big of a deal, but there's a lot of people in our society, they don't make 1 million in a year. Selena is on track to make that this month in August, and all of you can do the same thing too. All right, so we've covered the introduction, we've covered the benefits. Now, what makes our approach different? Because you can go to Chase Bank, frankly, I'll give you some names. You can go to JP Morgan Chase and get an ABL. You can circumvent us and just go right to Chase. But most people won't qualify without our assistance. So let's talk about how our approach works, because we're not the ones extending the loans. We're what's called the technical advisors. So what we are going to do is provide a portfolio, nice round number of $1 million of AR to the grant participants that want to participate in ABL. That allows us to put those assets on their balance sheet. And that matches what we were talking about earlier. So this is allowing clients to borrow money based upon their assets, and the type of assets that we're going to provide them is AR. real accounts receivables. So that is the first aspect of our unique approach. Now, these assets don't come free, and we wouldn't even be able to give them away free or they wouldn't work because they need to be owned by the client. They're not gifted. They're not a lease. It's not a loan. It's not a wink wink deal. So we actually are able to sell these because of the grant subsidy for 1 cent on the dollar. We've talked about this last week. So you're looking at $10,000 to buy $1 million of AR. Well, is that a good deal? Well, we talked a couple weeks ago about the concept. It's not what something costs, it's what something is worth that determines if it's a good deal. Well, $1 million of AR, it's really $1 million of AR. It's not something else. It's $1 million of AR. So if you can get $1 million of AR of assets for 1 cent on the dollar, it's phenomenally good. It's not an expense. For those of you that know accounting or took accounting, there's a difference between buying assets that produces income, like Rich Dad Poor Dad, Robert Kiyosaki taught us, versus expense. This is buying an asset, $1 million portfolio for 1 cent on the dollar. Now you might say, well, that sounds fine, but I only work with broke people. My broke people, they don't have 1 cent on a dollar to buy it. Well, then what can they do? They can use the quick cash program if needed. And again, we've had trainings on quick cash, and you can learn more about it on 509 Pacific. The question we commonly get, and it seems to kind of be the questions that I'm getting peppered here with from some of you, is what if they want more than $1 million? Because we need collateral, right? So the concept of asset-based lending is having the assets to pledge. So it's normally a dollar for dollar ratio. So if we had $1 million of AR, we would probably only qualify for $1 million loan, which is still a big number. But what if someone needs more than that? Then that's the point of the second sub bullet. We can provide a client multiple portfolios. So let's say they wanted 2 million, then 2 million in capital raise, then we could provide them 2 of these portfolios. But the portfolios are set up in $1 million increments, sold at 1% per. If they don't have the 1%, then we can always use normal third-party financing and or quick cash. So that's step one, or element one of our unique approach. But there's a lot more to that. So it's understanding the full picture that makes this almost too good to pass up. So once we transfer that AR, now it's legitimately theirs. There's a bill of sale, it's their asset, no questions about it. But then we're not going to just leave it as AR. We have a licensed, bonded, and insured debt collection agency that's then going to work with the client to liquidate the AR. Well, why would someone want to liquidate the AR? Well, number one, lenders are going to expect it to be liquidated, right? So if we're leveraging accounts receivable to qualify for an asset-based loan, which could be a loan or a line of credit, by the way, but if we're using it to access ABL, it's under the premise that the client is actually collecting the AR. Otherwise, it's not what it's represented. So number two isn't just a nice to have, it's really a requirement. And then we have to do one of the downsides of ABL, there's more reporting requirements, not of how you use the money, no one really cares, but how is that asset performing? So that's one of the things that we take care of, are the reports that are necessary, as long as the client's allowing us to liquidate the AR. So we would never want to just get AR and just leave it. We want to collect it. And why we want to collect it is, in addition to qualifying for funding, it puts cash in our account, right? So AR will decrease, cash will go up, right? Because the debtors are paying. Well, why would we want more cash? Well, that makes our income statement, otherwise known as a profit and loss, look better, creates strong bank statements. So we show that we have good deposits, good cash flow coming in. and it creates a solvent, a liquid business. Anyone have questions on number 2? And then, of course, on number 3, the point is using it for ABL. So let's see if there's any questions here. So Kenny's asking about number 2. So once we transfer the AR, we can go ahead and generate the initial reports for the lenders that has an AR aging and the breakdown that they want to see. That's fine, but it is advisable that we do start the collection process, the liquidation process. Why? Because number one, the lender is going to want to see that we actually have a plan in place to collect that AR. Because if they're basing the loan, the asset-based loan or line of credit, on collateral on the assets off the AR, it's assuming that the AR is going to be turned into cash. So that's what's allowing the borrower to get the loan, because the assumption is money will come in off the AR so they can afford the loan payments. If we're not collecting that money, then it's a broken system. Sure, we have AR, but it's not being collected. So we definitely want to be liquidating the AR, both from the sense of loan qualification, but also to get the money coming in. And so theoretically, let's say that, and we used this example last week, let's say that we're going after $1 million loan. So they get one portfolio of AR. As we liquidate this, theoretically, the liquidation of this, the money that's coming in into our bank account, I guess bank account here, it's enough to pay the loan payments each month. So it essentially, theoretically, could cover the loan payments. So that's what makes our approach unique. You can certainly go to JP Morgan Chase and some of these banks and get an asset-based loan, but number one, you have to make sure you have the assets. And then it's not just the assets, it's the liquidation of the assets that's important for approval. So with that, let's move on to the action steps, and then we'll wrap it up unless there's any other questions. So what are the steps? So first of all, we want to provide each client an express shelf corp, and that comes free through the grant. There is a processing fee. How much is a processing fee? It depends upon the reseller or branch office they get it from. But the grant does cover the shelf corp. It used to be 10,000. Grant covers all 10,000 of that. So we need a shelf corp because we need the foundation of a fundable business entity to get any type of funding. So the shelf corp, of course, provides the entity that's in good standing both at the state and federal levels, includes the commercial address, business plan, use of funds, and again, use of funds wouldn't be as important with ABL, financial projections, and so forth. So the shelf corp comes kind of like a business in a box, and then if we need to make any edits to that, we certainly can. So that's step one. Now we get the question a lot of, well, if a client already has a business, why don't we go ahead and use their existing business? Well, that's what we used to do, but when we use clients' existing businesses, there's a lot of time and effort, and there can often be surprises of, is that business set up right? Is it fundable? And so instead of spending time and energy evaluating that, it's easier for them just to take one of the free shelf corps, because then we know everything is set up. So it's faster, it's simpler, it's easier. Theoretically, we could do this with their own entity, but that takes time, effort, and it can also take longer. Therefore, we would rather just give them a free shelf corp. So then with the ABL approach, then we'll transfer the assets to them as much as they need in $1 million increments based on how much funding they want. Then we'll go ahead and initiate the liquidation, because we talked about why that's important. It's important because we want cash, but we also want to show the lender that we are collecting the money. It's not just assets sitting there growing old. We can make any refinements to the loan package. So again, The base documents for the shelf quote come standardized, but we can make changes that are needed, whether they want to change the amount of the funding that they're pursuing, if they want to change the name of the shelf corp, and any of those things we can do. Then we apply, and then we get funded. So those are the 6 steps. So kind of wrapping it up, and then we'll get to your Q&A. So we're going to help you get funding. It's guaranteed in writing, or help your clients get funding. We're a 501c3 nonprofit. We applied for and received a grant to assist small businesses in qualifying for funding. We've talked several times about the 3 mandates of the grant: to educate, build financial literacy; number 2, provide the free shelf corps; and number 3, use 1 and 2 to get funding. Our approach is risk-free to the clients. We put it in writing. We're on the hook, and that we promise them, we guarantee them that we'll be able to get them funding if they follow our model. Again, more information on 509 Pacific. And then also, if you have specific individual questions, text us. This is not a telephone line that's answered. You'll see our main number for the nonprofit on the website. This is a text line, 903-347-8042. All right, so let me get over to the questions. I know we've covered some. Let me see. Drake asked, and he asked us a little earlier in the discussion, is there a limit? So no, there's not a limit. We normally go in $1 million increments, but there's no limit, as we've covered. And then he asked how much they pay, and I told you it's 1 cent on a dollar. And then we can either finance it through third-party financing, or we can use quick cash. So I think we covered that. I just read his question too late. Kenny brings up the point of SBA versus asset-based lending. And so SBA is fine, and we could do SBA in addition to or in lieu of, but with SBA funding, it's going to require more documentation, more underwriting, takes longer, and it's going to have restricted use of funds, whereby the ABL is unrestricted. So both are good, both are fine. We help clients with both on a daily basis, but normally we're able to, as we go through the client discussions, determine what's the best fit based upon their wants, needs, and mitigating circumstances. Next question is, could we get 40 million? Yeah, so again, I don't know what else to say. That it comes in portfolios of $1 million, and we said that we can leverage multiple. So yes, that would be 40, of course. All right, Corinthian gives me a thumbs up. Thank you, Corinthian. Kenny is asking about money being deposited in the bank account. Well, sure. So when we're liquidating the AR, that's going to create cash flow into the client. So it's going to put money in their bank account that'll be reflected on their bank statements. It'll be reflected on their P&L. And if they need us to handle that part of the reporting, we can too. What I was referencing earlier is that we would handle the AR reporting that most ABL lenders want, either on a monthly or even weekly basis. Schiller asked, if he wants to do ABL, does he have to pay in up front? Well, technically, no. I mean, we're providing the AR for 1 cent on a dollar, which is a great deal. It does need to be paid for, otherwise it's not a lawful transfer. There's no consideration. But do you have to pay for it out of pocket? No, of course not. We could go get a third-party loan, or we could use quick cash, as I've stated several times. So do you have to pay for it out of pocket? Do you have to have anything out of pocket for this? No, no. We could finance this through third-party lending and or through quick cash. Thank you, Schiller, for your question. Let's see. Jennifer asked, does the cost come out of funding? Well, sure. So asset-based lending pays to you the same as an SBA loan or any other type of funding. And I mentioned that here. So you're paid 5% of each client's capital raise. That's because we charge the client 10% of the capital raised and half of that goes to you. But this is, of course, paid after they're funded, not before, after. So, yeah, to me that made sense, but maybe I didn't make it clear enough. But yeah, the client pays the performance fee after they're funded, and thus you and we get paid after they're funded. But that creates a nice aligned incentive. All right, got a bunch of questions here. Let's see. Kenny says 3,000, no, $333,333 a month in deposits. I don't know what that means. Maybe that's your bank account, which is a really good bank account, but I'm not sure what you're asking or stating. Let's see. Age of collateral. Ben brings up a good point. So when we transfer the accounts receivables over, we're going to take responsibility for managing the AR aging report. All of it will be reset to zero. So all of the AR will show that it's new AR because it is new. It just transferred to the client. And then AR aging reports normally break it down into 0 to 30 days, 31 to 60, 61 to 90, or 90 days or older. So you're right, Ben, that AR aging reports are important. We'll take care of that for the client as long as they're using our liquidation, and it'll all start with day 0 when the AR is transferred over. All right, Mario asks, are there licenses that are involved? Well, sure, to do what we do, you do need to be licensed, bonded, and insured, but we are Mario, so you don't have to be, and your client doesn't have to be. Kenneth asked if opening up a branch office, and there's no royalties, and I think that's what different Kenneth, by the way, than the one earlier, but we don't charge royalties. It's not a franchise, and there's not any royalties. You keep 100% of your profit. And there's other trainings on 509 about the branch offices. Shauna asks, can she do quick cash to fund your? Yeah. So quick cash is available to anyone. It's not like it's restricted. You go to 509pacific.org and you can access quick cash for whatever reason you want. It doesn't have to be just to get AR. Sorry if I didn't make that clear. Drake's asking about the money collected, and that's right. So we are licensed, bonded, and insured to collect money. So we don't do it for free, which is what Drake is pointing out, but our cost of collection is added on top of the base amount that the debtor owes. So essentially, the debtor is paying us to collect the money from them. I know it sounds kind of funny, but that works out really well, keeps the client from footing the bill. Mario asked, what types of businesses would be good candidates? Well, so we don't care about the age of the business, and we don't care about the industry, and we don't care about the use of funds. And frankly, Mario, they don't even need to have a business because what are we going to do? We're going to provide them a business in step one. So I don't think that there's any restrictions. It's just for the reasons I've stated. Here are the benefits. And normally we will just consult because all clients start the same with this. So then we can consult with them and determine is ABL the right fit or not. Now I realize some of you may go out and open with that to generate prospects, which is fine. But from our implementation perspective, all the clients start the same. And then we do a needs analysis and determine what the right type of funding is for them. All right, well, we ran a bit long. Hopefully this was helpful. Let us know if you have any questions. The best way to get support is to text us 903-347-8042. Have a great day, and we'll see you back tomorrow morning. Thanks, everyone. Bye-bye.